Cash, lease, or finance? Which one actually wins? I'm going to show you the real math, not the sales floor version, so let's get into it. The finance office isn't going to walk you through this decision because they don't make their money on what's best for you. They make it on the structure of the deal. Walk in with a payment number in your head and let them reverse engineer the term, the rate, the add-ons, and $32,000 car turns into a $41,000 commitment. This guy runs the real numbers on cash, finance, or lease, side by side, before you ever sit down at the desk. Paying cash means you hand over the full price and walk away with clean title, no lender, no monthly payments. Simple, and on pure interest cost math, it's the cheapest. But cash isn't free money, it's capital. And capital has a cost when it sits in a depreciating asset instead of working for you somewhere else. Cash is the strongest for buyers who have a fully funded emergency reserve and won't be in any type of strain to make the purchase. Financing splits the difference. You own the vehicle, you build equity with every payment, and your cash stays working somewhere else, but you're paying interest for that flexibility. Here's the thing, the term length is where finance deals are won or lost. 60-month loan on a $35,000 car, 6.5 interest runs about $685 a month, with roughly $6,100 in total interest. Stretch that to 84 months, and the payment drops, but total interest jumps past $8,300. And you're underwater on the loan for years longer than the car stays new. Shorter is almost always a better deal, even when the payment looks worse on the sticker. Leasing is renting the car's depreciation for a fixed term, 24 or 36 months, with a lower monthly payment than financing the same car. No ownership at the end unless you buy it out. Here's an insider tip. The lease money factor is just a hidden interest rate. Multiply it by 2,400 and you get the real APR. Always ask for it directly because dealers aren't required to volunteer. A lease that looks cheap monthly can still carry a worse effective rate than a finance deal you would have qualified for. Let's put real numbers side by side. The same $35,000 car, held or driven for 5 years, 12,000 miles a year. Pay cash and your monthly outlay after purchase is zero, but you gave up the large lump sum on day one. Finance it over 60 months and you're about $685 a month with roughly $6,100 in interest. And you'd end up with full equity. Lease it twice over 3 years and you're about $460 a month, but you'd end up with zero equity and real mileage risk. These numbers are illustrative. Your numbers will vary and there's a worksheet in the guide to run your own. So which one actually wins? For most buyers, it's finance, short term, on a competitive rate with real money down. A well-structured finance deal builds real equity, keeps your cash liquid, and carries no mileage ceiling. But a well-structured is doing the real work in that sentence. Stretch the term to 72 or 84 months. You skip shopping the rate or start with a thin down payment and the finance option disappears. Cash wins instead when your reserves are strong and this purchase won't touch your safety net. Lease wins instead when you drive low, predictable mileage. Always want a new car under warranty. The wrong move isn't picking cash, lease, or finance. It's picking any of the three without running your own numbers first. Quick gut check. Drive more than 15,000 miles a year, finance or pay cash, never lease. Self-employed or running a business, lease or finance can both work, but talk to your CPA first. Building credit, finance. Structured payments will help your history. If you keep cars longer than 7+ years, cash or finance wins every time. And if you always want the newest model, that's exactly what leasing is built for. A few things the finance office won't volunteer. Negotiate the out-the-door price first, before financing or trade-in ever comes up. Manufacturer incentives often require financing through the captive lender, so paying cash can actually cost you a rebate. Gap insurance is almost always cheaper through your own insurance or credit union, and extended warranties are negotiable. Get an outside quote before you sign anything at a dealership. If you want the full breakdown, every pro and every con, the complete numbers, the decision framework, and a worksheet to run your own math before you walk into any dealership, grab the field guide. Links in the description. See you in the next one.